Welcome back, YouTube. My name is Ryan and this is Scalpology. In this video, we are going to go over basic stock market terms that you need to know to understand technical analysis and to sound smarter to your friends, all right? If you want to know what I'm talking about in my videos, then stick around because this is the video for you. Bam, basic stock market terms you must know, all right? And some slang terms for those boomers out there if you stick around to the end of the video. Bull market, this is an important one, okay? A bull market is the condition of a financial market in which prices are rising or expected to rise. Think about it as a bull hitting you up in the air with his horns, okay? Prices are rising, that's a bull market, all right? Bull market, it can refer to the stock market, but it can also refer to any other financial vehicle that's traded, bonds, real estate, currencies, and commodities, all right? We were in a bull market in real estate for the last, 5-6 years. Because prices of securities rise and fall continuously during trading, that means they go up and down every minute of the day, right? A bull market is typically reserved for extended periods in which a large portion of security prices are rising. Bull markets tend to last for months or even years, all right? So when a stock market's gone up for the last 2 or 3 years, we're in a bull market, okay? So we reserve bull market for long-term trends, similar to a bear market. A bear market is when market experiences prolonged price declines. It typically describes a condition in which security prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment and media FUD like Jim Cramer. Okay, we recently entered a bear market because the S&P fell under the negative 20% on the year. That is a technical constitution of a bear market. Bear markets are often associated with declines in overall market or indexes like the S&P 500, but individual securities or commodities can also be considered to be in a bear market if they experience a decline of 20% or more over a sustained period of time. So your next term is bullish or bearish, you're long or short. These terms describe market direction or position direction, all right? Bullish is long. If you are long, you are expecting upside. So you've bought stock, you've bought calls. Now, if you're bearish, you're short. And if you're short, you're expecting downside. So bearish, bullish, long, short describes market direction and position direction. Now, consolidation, man, this is where traders don't want to be. Consolidations, the chop zones, the kill zones. Consolidations in technical analysis refer to an asset oscillating. Oscillating means going back and forth between a well-defined pattern of trading levels. Consolidation is generally interpreted as market indecisiveness, which ends when the asset price moves above or below the trading pattern. This right here is a consolidation. Notice up, down, up, down, up, down, up, down, up, down, right on defined price points. That's a consolidation. We as traders, we don't like to be here, okay? This is where most traders give back their money. You like nice trends, right? You like trends. You don't like consolidations. Next one, BidAsk Spread. BidAsk Spread is very important because it's the amount by which the ask price exceeds the bid price for an asset in the market. The bid-ask spread is essentially the difference between the highest price that a buyer is willing to pay and the lowest price that a seller is willing to accept. That's important because we're trying to get in or out of a trade. Sometimes we got to hit the bid, sometimes we got to hit the ask, right? Or sometimes we get filled at the spread. So it can affect our profit and loss, especially if the stock is very spready. An individual looking to sell will receive the bid price while one looking to buy will pay the ask price, okay? So an example that buyers want to buy the stock at the bid for $1, sellers want to sell at the ask. So $1.50, the spread is 50 cents. So sometimes you get filled at 125, all right? You're not going to get filled at 150. You're going to get filled at 125 or $1, okay? So that, depending on your position size, that can really affect your profit and loss. Stop loss, take profit, the most important term you need to know because this is where you're going to hold on to a majority of your money. A stop loss is a type of order used by traders to limit their loss or lock in a profit on an existing position. Traders can control their exposure to risk by placing a stop loss order. That means that, if you buy a stock at $1.50 and you put a stop loss in at $1 saying if it goes any lower than $1.01, you want to sell, okay? That means if it goes down to 50 cents, you're no longer in that position. You've stopped your loss, right? You've limited your risk. Very important. A take profit order is a type of limit order that specifies the exact price at which to close out an open position for a profit. So the opposite of a stop loss, you're in profit, and let's say the stock's trading at $1.75, and you say at $2, if the stock hits $2, I'm going to take profit, all right? So very simple terms, but important. Margin is the leverage a broker will give you to trade with. Okay, for example, you have $2,000. If a brokerage gives you 2-to-1 margin, you can trade with $4,000. Okay, your cash deposit is $2,000, but you're able to buy stocks with $4,000. Similar to if a broker gives you 4-to-1, you could trade with $8,000, right? So Interactive Brokers gives 4-to-1. If you deposit $25,000, you could trade with $100,000 worth of capital. Margin ends up equaling your total buying power. Liquidity, very important. In other words, liquidity describes the degree to which an asset can be quickly bought or sold in the market at a price reflecting its intrinsic value. Liquidity is very important because we need to be able to get in and out of trades, all right? Volume, how many shares are available and how many people are buying and selling that particular asset. Liquidity is obviously very important when choosing which stocks we are going to trade because we want to be able to get in and out and we don't want it to be very spready. Liquidity affects the spread. The less liquid a stock is, the more spready it is. The more liquid a stock is, the less spready it is. Ticker symbol. The stock's ticker symbol is a unique series of letters assigned to a security for trading purposes. Stocks listed on the New York State Stock Exchange can have 4 or fewer letters. NASDAQ listed securities can have up to 5 characters. Symbols are just a shorthand way of describing a company's stock, right? So Apple, ticker symbol AAPL. NVIDIA, ticker symbol NVDA, AMD, ticker symbol AMD, Nike, ticker symbol NKE. Very simple. If somebody says, what's the ticker? They're just referring to, how do I find the stock? What do I type in to find the stock? $TSLA, Tesla. All right. Barney stuff. Last one I got for you guys, support, resistance, floor, ceiling. The concepts of trading level support and resistances are undoubtedly 2 of the most highly discussed attributes of technical analysis. Part of analyzing chart patterns, these terms are used by traders to refer to price levels on charts that tend to act as barriers, preventing the price of an asset from getting pushed in a certain direction. If we take a look back at the chop zone, this would be considered a resistance, okay? This would be considered a support. Support, resistance, resistance, all right? Then the resistance gets broke. This is called a breakout. If you're interested in learning more of this, click the links in the below and take my free day trading course. Guys, if you found value in this video, I invite you to like, I invite you to subscribe, click that bell notification so that you can stay tuned for future videos, and I will see you on the next one.